So markets will probably be ending this week in an oddly upbeat mood where bad data is good news, good data is rare, and everyone pretends not to see the US economy limping behind the AI parade. The S&P 500 is brushing against all-time high levels. The US dollar is wobbling on key support, and yields are dancing to Japan's tune as Bank of Japan flirts with yet another rate hike this December. And then along comes more threats. China's fresh-faced GPU upstart, exploding nearly 500% on its Shanghai debut today and injecting yet another shot of adrenaline into this market already high on AI fumes. So between fragile macro signals, rising global yields, and this never-ending AI appetite, the market feels like it's sprinting with one shoe untied, but sprinting nonetheless. So welcome to Swissquote's Daily Market Talk. We are December 5th. Happy Friday. I'm Ipek Özkardeskaya. We will talk about a bunch of crunchy stuff today, but before we do, and as always, keep in mind that opinions are my own, and this is not financial advice. Looking at the S&P 500, that's flirting with all-time high levels, and the US growth forecast for the third quarter hugging the 4% mark, you'd barely think that the US economy is suffering, jobs are being lost, and the Federal Reserve is about to cut the interest rates for the third time in a row. This is how much the US technology sector and AI investments mask the ugly reality of the big and beautiful US economy, without even mentioning the ballooning US debt level that is rising by the second toward the 40 trillion psychological and scary mark. So the US dollar is losing its global appeal since the start of this year, at least, as the world's go-to currency is no longer the US dollar. The Chinese are trying to slow the yuan's appreciation, while the Japanese are preparing for a rate hike this month, and that despite the unstoppable rise that we see in the Japanese yields, with the 10-year JGB yield reaching the 1.95% level today, that continuously threatens to bring the Japanese trillions of dollars invested in global markets back home. The US 10-year yield is also being pushed higher for that very risk, even with the softening Fed expectations. And given the rising bets that the Bank of Japan's December rate hike won't be its last, and the gradual pricing of an increasingly hawkish Bank of Japan, the Fed's December rate cut could remain a bit light if it comes with cautious comments regarding the future intentions for the Fed policy, because the Dows do rely on Trump and his Fed picks to fight to lower the interest rates come hell or high water. But if investors don't play along and they don't buy the rate cut story, well, the yields in the US will not be pulled much lower. And if investors are convinced that the US 10-year yield's long-term seed is closer to 3%, rather than the 2% level, which is the Fed's official inflation target, the impact on valuations could be consequent. We could eventually see the technology stocks, for example, shed as much as 20 to 30% on that simple shift. So the hope is that the miserable labor data outlook of the US has a disinflationary impact on US consumer prices despite tariffs, and that the Fed gets to cut the interest rates as much as it wants and maybe announce a new round of QE next year as well. The US dollar this morning continues to test a critical Fibonacci support. If broken, will probably send the US dollar back to this year's weakening trend. A soft US dollar backs equity valuations, mind you, because foreign revenues are worth more US dollars when they are repatriated to the US for the books. But that's just an ephemeral makeup for the US economy that is what it is today, thanks to the strength of the US consumer spending that used to make around 2/3 of the US economic growth. But today it is said that the AI investments stand for around half of this year's GDP growth in the US. So that's not necessarily brilliant. So today's PCE data will have little impact, in my opinion, on the Fed expectations for next week. Both the headline and core PCE numbers from the US are seen sticky and close to the 3% mark, but steady. And in the absence of a data shocker, the US stocks will likely end this week on an optimistic note. Even more so as the technology appetite continues to dominate this morning's market mood following a 500% rally in more threats technologies first day in Shanghai trading. So More Threads Technology is a young and an ambitious company founded by a former NVIDIA executive in 2020. It is a Chinese tech company. It's trying to create a full-stack graphics and AI ecosystem from scratch. Chips, cars, software, data center, boxes, and the whole shebang. Really looks like NVIDIA. Their architecture, called Musa, aims to handle everything from gaming graphics to AI model training to high-performance computing, aiming to become China's NVIDIA, nothing less. Moreover, it has the government's backing and undoubtedly investor support as well if you're looking at the strength of today's IPO, and it could lift the Shanghai's composite up today. Let's see how NVIDIA will react to the news. Will it react negatively because it may further lose whatever is left from its Chinese business? Or will it react positively as investors get another confirmation of how strong AI appetite remains? I guess we will see that. Elsewhere, curiously, crude oil is set to finish this week flat. I say curiously because there has been a few news on the wire since last weekend that could have simply justified a rally in oil prices this week. One, OPEC confirmed last Sunday, remember, its decision to pose a supply restoration strategy for the first 3 months of next year in order to throw a floor under the falling oil prices. Two, the Trump administration softened its climate stance and goals this week. They also want to build and sell the Japanese mini cars called K cars, as Donald Trump apparently went to Japan, saw them, and liked them, making them apparently less risky for the big US roads all of a sudden. And three, the US-Russia talks this week yielded no real progress. But all these policy and geopolitical related factors barely managed to convince the buyers back in. And other typically supportive drivers for oil prices, like a weaker US dollar and softening Fed expectations that should boost global growth bets, weren't enough to spark a meaningful rebound in oil prices this week either. So WTI remains trapped below the 50-day moving average that stands near the $60 per barrel psychological level, also hugging the top of the August-November downtrend channel. So the medium-term outlook stays timidly bearish, whatever OPEC decides to do. Conversely, natural gas prices are rising on the back of a globally higher demand for nat gas, on news that the Europeans will try to sober up from the Russian gas earlier than previously planned, on waning hope to see a peace ink with Russia anytime soon, and also from a longer-term perspective on the fact that gas remains a safe play for investors and for the governments because it's both politically and commercially viable as a bridging alternative to the controversial field. And even with the White House U-turn on renewables and clean energy and all that stuff, LNG exports, domestic gas to power projects, and petrochemicals are growth areas. As such, natural gas actually does help companies, the traditional energy companies, to build a dual strategy, maintain cash flow from oil and gas while positioning for energy transition, even at a reduced scale. And the rising gas prices are, in my opinion, what keeps the energy companies' stocks well big these days, and that despite the subdued oil prices. Also note that energy companies, though boring because they won't change the face of the world like big technology does, will still be providing the energy necessary to run the AI-powered world. And they also pay good dividend, and they also have share buyback programs that are very interesting for investors that are scared that we will see another heat up in inflation figures in the coming year. So this is all for this week. I'm İpek Özkardeşkaya, and thanks for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.